Imagine investing in companies that not only drive strong financial returns, but also make a positive impact on the planet and society. In 2024, more and more investors are realizing that profits and purpose can go hand in hand. This is where ESG investing comes in, an approach that focuses on environmental, social, and governance factors to create a more sustainable future. In this video, we'll explore how ESG investing is reshaping the financial world and how you can align your investments with your values while maximizing your returns. Let's dive in. Understanding ESG investing. ESG investing, which stands for Environmental, Social, and Governance Investing, is an approach that incorporates non-financial factors into investment decision-making. It moves beyond the traditional focus on financial performance by evaluating how a company impacts the world around it. The environmental aspect looks at how a company manages its environmental footprint, including issues like carbon emissions, resource usage, waste management, and efforts towards sustainability. Companies that perform well in this area are seen as more resilient in the face of climate-related risks and are more likely to adapt to the growing demand for green solutions. The social component evaluates how companies treat their employees, customers, and the broader community. This includes labor practices, diversity and inclusion policies, consumer protection, and contributions to local communities. A company with strong social practices is likely to foster a positive reputation, employee satisfaction, and long-term customer loyalty, all of which can contribute to its financial stability and growth. For instance, companies that prioritize ethical labor standards and human rights are considered less likely to face costly legal or reputational issues. Finally, the governance factor looks at the management and leadership structure of a company. This includes transparency, accountability, board diversity, and shareholder rights. A company with solid governance practices is typically better at managing risks, maintaining ethical standards, and making decisions that promote long-term shareholder value. By considering all three of these areas, environmental, social, and governance, ESG investing provides a holistic view of a company's potential for long-term success and sustainability, both financially and ethically. The growth of ESG investing. ESG investing has experienced significant growth over the past decade, driven by a global shift in how both individual and institutional investors view the relationship between financial returns and social responsibility. Investors today are increasingly seeking ways to align their portfolios with their personal values, leading to a surge in demand for companies that meet high environmental, social, and governance standards. This shift is especially evident among younger generations, such as millennials and Gen Z, who are more likely to prioritize sustainability and ethical practices when making investment decisions. These generations are not just focused on the potential for profits, but also on how companies contribute to solving global challenges like climate change, social inequality, and corporate governance issues. As a result, ESG-focused funds have seen a sharp rise in assets, with billions of dollars flowing into investment strategies that emphasize sustainable business practices. In fact, ESG assets are expected to represent a significant portion of global assets under management in the near future, reflecting a broader movement towards responsible investing. This growth is also fueled by the increasing recognition that companies with strong ESG practices are more likely to be well-managed, adaptable to change, and capable of mitigating long-term risks, which translates to better financial performance over time. Financial institutions and asset managers have responded by creating a variety of ESG funds, making it easier for investors to access these opportunities. Moreover, the rise of ESG investing is not just a trend. It is now seen as a key part of mainstream financial markets. Governments and regulatory bodies around the world are increasingly encouraging or even mandating ESG disclosures, which enhances transparency and makes it easier for investors to evaluate companies on these important factors. In this environment, ESG investing is not just about social good. It's also seen as a way to future-proof investments and tap into the growing sectors of the economy that are focused on sustainability, ethical governance, and social responsibility. With the continued demand for socially responsible investments, the ESG space is poised to keep growing, influencing markets and corporate behavior for years to come. Performance and profitability. One of the most compelling reasons for the rise of ESG investing is the growing evidence that companies with strong ESG practices tend to perform well financially in the long run. While there was once a belief that prioritizing environmental, social, and governance factors might come at the expense of profitability, recent studies have shown that this is not necessarily the case. In fact, companies that emphasize sustainability and ethical practices often enjoy improved risk management, greater innovation, and stronger customer loyalty, factors that contribute to their financial success. By focusing on long-term value creation rather than short-term profits, these companies are better positioned to thrive in an increasingly complex and interconnected world. The integration of ESG factors into investment strategies has been shown to result in competitive advantages, particularly in sectors where environmental and social issues are becoming more critical. For example, businesses that reduce their carbon footprints or invest in renewable energy technologies are likely to face fewer regulatory challenges and benefit from the global push towards sustainability. Similarly, companies that foster diversity, maintain strong labor practices, and contribute to their communities are more likely to attract and retain top talent, as well as appeal to socially conscious consumers. These advantages, in turn, can lead to higher profitability and sustained growth. Moreover, ESG investing tends to reduce risk by focusing on companies with better governance practices, as these companies are more likely to avoid scandals, lawsuits, and regulatory fines. Strong governance structures also contribute to more effective decision-making, which can improve a company's ability to adapt to market changes and manage crises. As investors increasingly recognize the financial benefits of ESG-focused companies, the perception of ESG investing has shifted. It's not just about doing good, it's also about smart investing. As a result, many ESG portfolios have outperformed traditional investment strategies, showing that profit and purpose can go hand in hand. Mitigating risks with ESG. One of the most significant advantages of ESG investing is its ability to mitigate risks, particularly in today's rapidly changing and unpredictable global markets. Companies that are committed to strong environmental, social, and governance practices are generally better at managing the risks associated with their operations, which can lead to more stable and sustainable returns for investors. In contrast, companies that neglect ESG factors may be more exposed to various risks, such as environmental disasters, social unrest, regulatory penalties, or poor management decisions, all of which can negatively affect their financial performance and, by extension, their investors. For example, companies with poor environmental practices may face rising costs due to government regulations, fines, or increased operational expenses associated with environmental cleanup. Alternatively, firms with weak governance structures, such as lack of board diversity or transparency, may experience leadership conflicts, corruption scandals, or poor decision-making, all of which can damage their reputation and shareholder value. Social risks, such as labor disputes or inadequate attention to human rights, can also lead to negative publicity, legal battles, or disruptions in operations. By investing in companies that have strong ESG frameworks in place, investors are essentially reducing their exposure to these risks, which can be both financially and reputationally costly. Furthermore, ESG factors help identify forward-thinking companies that are better prepared for future challenges. For instance, companies focusing on renewable energy, waste reduction, and sustainable practices are better positioned to thrive in a world that is increasingly prioritizing environmental sustainability. Similarly, firms that promote diversity, fairness, and ethical governance are likely to foster healthier workplaces, stronger customer loyalty, and fewer legal or regulatory issues. As more investors recognize that managing ESG risks can lead to more robust and resilient portfolios, ESG investing is increasingly seen not just as a way to promote positive social and environmental change, but as a strategic approach to risk management that can enhance long-term profitability and stability. How to get started with ESG investing? Getting started with ESG investing is simpler than many people think. One of the most straightforward ways to begin is by investing in ESG-focused mutual funds or exchange-traded funds, ETFs. These funds pool investments into companies that meet specific environmental, social, and governance criteria, allowing you to diversify your portfolio while ensuring your investments align with your values. Many asset managers and financial institutions now offer ESG-themed funds, and these can be a great way to tap into the growing demand for sustainable and ethical investments without having to research individual companies yourself. Additionally, many of these funds have specific ratings or guidelines that ensure they adhere to established ESG criteria. Another approach is to build your own ESG portfolio by selecting individual stocks from companies that meet your specific criteria for environmental responsibility, social impact, and strong governance. This allows for more personalized control over your investments, but it requires more research and ongoing monitoring to ensure that the companies you invest in continue to meet ESG standards. You can also consult ESG rating agencies, which provide reports and ratings on companies based on their ESG practices. Whether you choose a fund or individual stocks, the key is to stay informed and ensure that your investments align with your financial goals and values, while also contributing to positive change in the world. ESG investing is not just a trend, it's a transformative approach that aligns your financial goals with a greater purpose. By focusing on companies that prioritize sustainability, social responsibility, and strong governance, you're not only making smart investment decisions, but also helping to shape a better, more equitable future. If you're ready to start investing with impact, remember that it's about balancing profits with purpose. Thanks for joining us today. Don't forget to like, share, and subscribe for more insights on how to make your money work for you and for the world. Until next time, happy investing.